To my channel. This is Blood Phantom 81. So today we're going to be doing a weekly stock market recap and update video. Notice I said weekly and not monthly because it's possible that these are going to come every week now. Now that I'm starting to ramp up my YouTube videos, I actually have a lot of great ideas for content coming down the line, but it's not really ready yet, I would say, or at least like I'm not ready yet to put it out. So maybe later this year or early 2021. But yeah, for now, I'm most likely just going to be doing recap and update videos, which I figure are probably more interesting and important, especially with how the market's been acting. Yeah, so let's just jump right into it. So I think my last update, I was talking about how I think we're going to continue rallying in the major indices. The S&P 500 was sort of breaking out of its consolidation zone. And same thing with the Nasdaq actually, where I was more so looking for opportunities to buy really than I was looking for tops. With that being said, we are pretty overextended on the Nasdaq, especially in the short term. Now, obviously, that doesn't mean that we have to go down the very next day. It's just that the risk reward is not that favorable up here. It's not that favorable up here as it was down here, for example. So as a result, I've been taking pretty heavy profits. Now, that in itself is a risk that I can't deny because obviously there's risk and opportunity cost. If I sell too early and the market keeps rallying without me, where that's potential gains, which I consider to be a loss. But I try not to think about it that way. I think about it as like, okay, if I'm like, I may not time the exact top, but I just know that it just doesn't really fit with my system too well. I only like high probability setups, and to be honest, I haven't really been that leveraged for the past few weeks, just like slightly. So I'm not as leveraged up here as I was like down here, for example. So I've been taking mostly profits, and as a result, I think I'm like around 30-ish% in stocks, maybe 30 to 40, something like that. Mostly in cash, though, honestly. Again, with enough skin in the game to at least profit off of further rallies, but mostly I'm taking some protective measures. So let's go ahead and talk about why I'm selling. First, we'll do a discussion on my portfolio. All right, so this is the portfolio sitting pretty at 180K. I think my previous update I was at around 173K. So about a 7K gain over the past week or so, which is pretty solid. Again, I haven't really been fully leveraged as I mentioned, so I've mostly been taking profits, so not really like huge gains. But yeah, I actually I haven't been adding money into this account. In fact, I've been taking money out, unfortunately. And I think my first paycheck of my new job is finally going to come in like a few weeks. So for the first time, I'll be putting money into my Robinhood account rather than taking money out. So let's say I never took any money out. I think I might be sitting at like, I don't know actually. But yeah, anyway, so the numbers are a little bit distorted. But yeah, enough about my life, I guess. So I'm 20K away from $200,000 right now. So let's just go ahead and put that into perspective. So a little over 10% away from $200,000. The great thing is if we do see some kind of sustained consolidation going into Q3, which we're already in Q3, but some sustained consolidation over the coming months, something like a 10% correction all around, which I'll go ahead and talk about in a second. But yeah, assuming we see that and I'm able to re-leverage myself, it's possible that this account really, really blows up. So that's probably the most exciting thing about taking profits now. Yeah, and the other thing is I did go ahead and just buy a put option recently. I'm already up about 11% on it or so. So I profited about $100. I bought two put options. Once I got like a pretty solid gain on one of them, I just sold it. And now I'm letting this one ride, so to speak. Actually, let's go ahead and check it out. So this is the option that I bought up 20%. And this happened in a few hours too. And yeah, for the first time, I'm actually shorting a little bit. Definitely timing tops is a lot harder than timing bottoms in the market. So as promised, we can go ahead and discuss why I started taking profits. So you guys know I like to see how far extended price action is above major moving averages. such as the 200-day. It doesn't get any simpler than that. So this is the NASDAQ. As I mentioned, this is QQQ ETF, and somewhere like where we open, we're approximately 17, close to 18% above the 200-day moving average. Honestly, let's call it 18%, which is pretty extended. That doesn't mean we have to break down right now. It's just about risk to reward, as I mentioned. And recently, this came off of a gap up open yesterday. And so if we have a gap down of any sorts, whether it's tomorrow or sometime this week, then this would form an island reversal, which is a pretty strong reversal. And yeah, I would expect some follow through. The only odd thing about the market right now that's just really been puzzling me is the discrepancy between the Nasdaq and the S&P 500. So obviously, when you zoom out at this, I mean, it just looks like an absolute monster rally, really, with not too many pullbacks. So if you guys haven't been in this market, it's been really difficult to get into it. There's hardly been any opportunity, especially with all the bad news going on. Whenever the market does break down, we would expect to see something further. Like when the market broke down here, I was like, okay, this is the big one. But nope, we got right back up. When the market broke down here, it's like, okay, now this is the big one. And it got right back up. And it was even more violent of a recovery than this time. So it's extremely frustrating for a lot of people who haven't been taking advantage of this. Again, that's why it's so hard to time the market, especially if you're looking at fundamentals or just focusing on the news and that kind of thing. It's really easy to get biased, I would say. And it's funny because a lot of people say the market's rigged, and it's like, well, if you know the market's rigged, then why don't you make money? You know what I mean? Like, if you know a game's rigged, then just play the game the rigged way then. Anyway, just taking shots at some people. Not you guys, of course, but just people. Anyway, so yeah, this is the NASDAQ, and let's go ahead and look at the S&P 500 for a second, because that's where the discrepancy comes from. That's just like really curious, I would say. So for how extended the NASDAQ is, we would expect the S&P 500 to perform a little bit better. But honestly, a lot of the sectors that are non-tech have actually been lagging. So financials are not looking too good. Let's go ahead and take a look at financials. So here's financials getting rejected off its 200-day moving average and just nothing but just a slow fade. Here's industrials also getting rejected off its 200-day moving average, and again, a bit of a slow fade. Definitely a little bit stronger than financials, but still not the kind of look that you'd want to see off of a major bottom. So it might need some work before it gets above and does a sustained hold above the 200-day moving average. Consumer discretionary, on the other hand, has been absolutely killing it, and that's stocks like Amazon, I believe, is in XLY, and things like Starbucks and McDonald's, I believe, are also in XLY. So it's no surprise that sort of growth stocks and more aggressive growers are doing well. Utilities are not doing too well, so obviously we have another clear rejection off the 200-day moving average, and I don't really see this as like bearish at all. It just means that maybe it needs a little bit more time to consolidate. But the really important discrepancy I want to point out here is like I don't know how much tech has left in its rally, and so we're either going to see underperformance of tech going forward, in my opinion, and we're going to see some of these sectors rotate, or tech's going to weigh the entire market down and we're going to see a bit more of a pullback. Obviously, none of that can happen, and we can still keep rallying, I suppose. But yeah, I'm not really super comfortable with being that heavy into tech right now, and I'm totally okay with missing another few percent. It's just a matter of probabilities, really. I mean, this is Amazon, for example, which does look a little overextended. Again, it's so hard to call tops in tech stocks once they really start picking up momentum. I mean, this is coming off like what is this, like a year and a half, almost 2 years of consolidation. So, Amazon has earned the right to continue rallying. But obviously when tech stocks sort of move, they move aggressively and then they consolidate. So we'll see if Amazon needs to pull back soon. But that's just sort of an example of once these tech stocks get moving, then they really start to get moving. And with not that much people participating in these rallies, I think it really fuels the rally even further. And the last data point I want to close with here is the 1 month average of the put call ratio. So, and before I dissect it, I just want to say that like I've seen plenty of times where people use data points to really paint a narrative in their favor or like agree with something they really wanted to believe, aka bias. I try to only pick data points that like make sense and that I think would actually have an effect on the markets. A lot of people use like, oh, a number of tweets with like a certain word or like number of times that President Trump tweets XYZ and then like plot it against the market and be like, oh yeah, see, this is clearly correlated. I prefer things like this, like put call ratio is pretty simple. And for those of you that don't know what this is, it's basically like think about it as like demand for puts divided by demand for calls. So if this number is small, then that's like extreme bullishness and extreme optimism. And extreme optimism is used as a contrarian indicator. And this might look a little funky because we would expect extreme bullishness to yield a very large number. Whereas in this case, it's yielding a very small number, but in fact, this scale is actually reversed. So the smaller numbers are higher. And so, yeah, it basically works as like overbought at the top and then oversold at the bottom. So yeah, let's just go ahead and walk through some of these examples. So this is over the past 20 years or so of the 1 month average of the put call ratio. So yeah, when there's extreme optimism, we expect some sort of pullback. And the pullback may look a little bit complex. It may not be super straightforward, like an immediate drop. It may take some time to consolidate. Like this example for example, was actually maybe like a few months of consolidation. It's just really zoomed out, so it doesn't look like it's that large, but it really is. I'm assuming this is something like a 15% pullback from top to bottom, which lasted a few months. And yeah, it came pretty soon after the first signal. And then right here, I think this was something like a 12% drop in the S&P 500, and this also came after a really large rally. This is the 2009 bottom. This drop right here was a little bit more complex. It came after, the drop came after maybe a month after the original signal, and this was something like a 20% drop. Here we sort of had like a really small one. I think this is probably like a 10% drop in the S&P 500. Not that huge. And then obviously this one was just a massive drop. And in fact, right now the put call ratio is more overbought now than it was before this massive correction. So yeah, I mean, this data point alone wouldn't tell me that much, but like this plus the Nasdaq being so overextended, just putting puzzle pieces together, I don't really like the risk to reward setup here. And that is in fact where I'm going to wrap up the video. And just in summary, like I could obviously change my mind within a week if I feel like the market has corrected enough. Maybe all we get is a 5%er. And yeah, I mean it's just about being flexible. So don't sue me if you guys are losing money or something. This is just me. This is what I'm doing with my money. Just trying to get better every day, every week at investing. And yeah, thank you guys for being along with me on this journey. I hope you guys have an awesome week, and I'll see you guys next week.